Welcome back to the deep dive. Ever wonder how a company, not from Silicon Valley, but from Kansas, becomes this $44 billion tech giant?
Right.
I mean, dominating skies, seas, even our wrists, especially when smartphones seem like they'd wipe them out.
It's quite a story.
It really is. So today we're diving deep into Garmin Ltd, that's ticker GRMN. This is as of August 9th, 2025. We're aiming to really unpack their business, the leadership, the financials, where they sit in the market, and importantly, the risks. And we'll get to that big question. Is this fantastic company trading at a fair price right now? Or are there maybe some hidden challenges we need to be aware of?
And we've really gone through a mountain of information for you on this one. Everything from earnings reports, financial filings, deep industry analysis, market commentary. We synthesized it all to give you hopefully a real shortcut to getting up to speed.
Perfect. And speaking of earnings, just a quick heads up. Stock Analytics AI, that's us, will be covering Garmin's upcoming earnings report literally minutes after it drops.
Yeah, stay tuned for that.
Definitely. So make sure you're subscribed to the channel for that immediate live breakdown. Okay, let's get into it. Part 1, the company's core. All right, let's start here. How did Garmin pull this off? How did they not just, survive, but actually thrive with tech giants breathing down their necks?
Well, it fundamentally comes down to their vertically integrated model.
Okay, what does that mean exactly?
It means they control pretty much everything. Design, engineering, manufacturing, distribution, sales, even the support afterwards, end to end.
Ah, okay.
And that gives them tight control over quality, costs, and lets them innovate much faster. Their money comes mainly from 5 big hardware areas: fitness, outdoor, aviation, marine, and auto OEM.
So they're diversified.
Hugely diversified, which really helps cushion them if one area slows down. And they're not just hardware anymore. They're pushing into recurring revenue. Think subscriptions for things like their InReach satellite SOS.
Oh, yeah, the safety device.
Exactly. And their new Garmin Connect Plus premium stuff. Plus, they do a lot of OEM work, building their tech right into cars, boats, planes for other manufacturers. That's a big piece, too.
So bring it down to the products. What are we actually talking about? Like, what are people using day to day?
Sure. So in fitness, you've got watches like the Forerunner series, really popular with runners and triathletes, or the Venue line, more stylish, but packed with health stuff like ECG, blood oxygen,
Right.
and even things like their Tacx indoor bike trainers.
Yeah.
There's a whole ecosystem.
Yeah.
Then outdoor, which is actually their biggest segment revenue-wise.
Bigger than fitness.
Yeah, currently. Think the Super Rugged Phoenix watches for hikers, climbers, adventurers. And those InReach devices we mentioned, genuinely life-saving tech for off-grid communication. Now, aviation, this is fascinating. It's high margin, heavily regulated. They make integrated flight decks like the G3000 Prime. It's basically the brain of the cockpit.
Okay.
And the really big one here is their autonomy suite, specifically Garmin Autoland. This thing won the Collier Trophy, which is a huge deal in aerospace.
Autoland. So it lands the plane itself.
It's the world's first certified autonomous landing system for general aviation. If the pilot is incapacitated, a passenger can literally push a button, and the plane finds the nearest suitable airport and lands itself. It's incredible technology.
Wow. That's game-changing.
Absolutely. Then for marine, you've got chart plotters like EchoMap, fish finders, powerful force trolling motors, everything for navigation and control on the water. And auto OEM, they shifted away from those dashboard GPS units everyone used to have.
Yeah, the new 80.
Right. Now they integrate complex infotainment systems and digital cockpits directly into cars from BMW, Mercedes, Ford. And underpinning all of this is their software Garmin Connect for tracking your health and activities. Connect IQ for apps and watch faces. It makes the whole system really sticky.
That is a seriously broad and sophisticated portfolio. How big are they overall? What's their global footprint like?
Well, they've been around over 35 years now. They've got something like 21,800 employees, 89 offices in 35 countries, and they hit a record $6.3 billion in revenue in 2024.
$6.3 billion.
Okay.
And the market recognizes their leadership. They had the biggest slice of the premium smartwatch market, the ones over $500, back in 2022. Aviation product support, #1, for 20 years straight.
20 years.
And Marine Manufacturer of the Year, 9 years running. These aren't just, marketing fluff. It shows deep customer trust.
So boiling it down for the customer, for you listening, what's the core reason people stick with Garmin, even with, say, an Apple Watch available?
I think it goes back to their mission. Superior products. Essential part of our customers' lives. It really translates into reliability, features, and toughness. If you're a pilot, a sailor, an ultra runner, you need gear that works flawlessly in demanding conditions, maybe when your life depends on it.
Right. Function over pure fashion, maybe. Exactly. They focus on rugged utility and precision. That's a key difference.
Okay.
Okay, let's shift a bit now to the industry analysis. What's happening in their markets?
Well, there's some big trends. In wearables, it's moving way beyond step counting. Think AI, advanced health monitoring, ECG, SpO2 sensors becoming standard, maybe even smart rings taking off.
Yeah, more proactive health management.
Precisely. Aviation GPS. That market's looking at maybe 7% annual growth. Driven by more air traffic, the boom in drones, UAVs, and this steady move towards autonomous flight.
And marine.
Marine navigation also growing steadily, over 4%, maybe 4.4% CAGR. Think global trade needing more ships, tighter safety rules, even using AI for predicting when equipment needs maintenance.
Lots of opportunity then. But the competition must be fierce. How do they handle giants like Apple and Google?
It's definitely what you call asymmetric competition. They're not trying to beat Apple at being Apple.
In fitness wearables, yeah, it's Apple, Samsung, Google. Outdoor, maybe GoPro. Aviation, it's the big aerospace players like Honeywell, Collins Aerospace. Marine has specialists like Furuno, Navico. Auto, you've got TomTom still, plus Google and Apple platforms built in. Garmin's strategy is smart. They carve out their own niche. They go deep into high-end, feature-heavy segments where their specific expertise in GPS, sensors, and durability really shines. They avoid competing purely on price.
Makes sense. What about regulations? That must be complex, especially in aviation.
Oh, absolutely. Globally, they deal with things like RoHS and REACH in Europe, rules about chemicals, hazardous materials, plus consumer product safety, electronic waste rules like WEEE. But yeah, aviation's the big one. Getting FAA certification for their flight decks and systems, that's incredibly costly and time-consuming. It's a massive barrier to entry for anyone thinking of jumping in.
Ah, okay. A moat, essentially.
A significant one. And of course, data privacy is huge for connected devices. Garmin is clear. They state they don't sell user data.
So let's circle back to those barriers. What really makes it hard for a competitor to replicate what Garmin does? You mentioned FAA certification. What else?
Well, there are several layers. First, the technological expertise and R&D. Decades of specialized knowledge in GPS, sensors, algorithms, plus a big patent portfolio. The ongoing R&D spend alone is huge.
Gosh.
Second, brand reputation and trust. Especially in aviation and marine, people bet their lives on this equipment. You don't build that trust overnight.
No kidding.
Third, those regulatory hurdles we talked about, FAA being the prime example. Fourth, manufacturing and distribution scale. Their vertical integration gives them scale and cost advantages that are tough to match. And finally, the ecosystem and data quality. The Garmin Connect platform aggregates so much user data across devices. Switching becomes a real pain for loyal users.
Got it. So let's talk about that competitive advantage more formally.
Sure, their brand strength is definitely a crown jewel. It stands for quality, reliability. Those awards, 21 years in aviation support, 9 in marine. They reinforce that constantly and let them charge premium prices. Their cost advantages largely come from that vertical integration, especially owning their factories in places like Taiwan. It means tight control, faster prototyping, better quality, and a favorable cost structure, partly due to local incentives and skilled labor.
And the network effect, the switching costs.
Yeah, that's powerful too. Like we said, if all your health data, watch, bike, computer, smart scale is in Garmin Connect, moving is a hassle. That's high switching costs. In marine, they have the Garmin Marine Network connecting devices on a boat, and their One Helm feature is evolving to make Garmin essentially the boat's central operating system. That creates a really sticky network effect.
Okay.
And finally, unique assets. Things like that proprietary Autoland technology. Their mastery of vertical integration itself is rare, and their skill with advanced materials like the titanium and carbon fiber in their high-end MRQ watches lets them create very profitable premium products.
Okay, fascinating breakdown of the business itself. Let's shift gears now to the people running it. Chapter 2, Management Evaluation. So, who's at the helm here? And more importantly, how have they done, especially when things got tough?
The leadership story at Garmin is really one of stability and deep experience. You have Clifton Pemble, the CEO. He's been with Garmin since 1989.
Wow, since the beginning, practically.
Pretty much. Started as a software engineer, worked his way up, became CEO in 2013. And Dr. Min Kao, the co-founder, is still executive chairman, providing that long-term strategic view.
So, real institutional knowledge.
Exactly. And their big test, the defining moment, was absolutely the smartphone threat. It just crushed the market for their main product at the time, the PNDs, the card GPS units.
Right, I remember that. Everyone thought they were done for.
Many did. Their first try at a response, the Mivaphone, it didn't work out. It was a failure.
Yeah.
But here's where the leadership quality shows. They showed remarkable strategic humility. They learned, adapted, and executed this masterful pivot.
Towards those niches we talked about.
Precisely. Fitness, outdoor, aviation, marine. They doubled down on their core GPS expertise, but applied it to these higher value, more defensible markets. That successful transformation, frankly, is incredibly impressive. It shows they can handle crises.
That really is a key point. Shows they can adapt. What about how they communicate? Are they transparent? What's their reputation like ethically?
They seem quite solid there. Their investor relations website is very comprehensive, lots of information, and their stated values, honesty, integrity, respect, seem backed up. Forbes ranked them #2 on America's best large employers in 2024. That suggests employees feel good about the culture.
Okay, good signs. Now, how do they handle the money, capital allocation? What do they do with the cash the business generates?
Their priority is clearly reinvesting in the core business through R&D. They spent almost $1 billion on R&D in 2024.
$1 billion.
$994 million.
Yeah.
That's about 11% of their revenue. It really shows that relentless pursuit of innovation isn't just a slogan for them.
And acquisitions, M&A.
They do M&A,
Yeah.
but it's very disciplined. Mostly smaller, bolt-on deals. Things that add specific tech or strengthen an existing segment, like buying for-speed analytics for heart rate algorithms, TACs for indoor trainers, JL Audio for marine sound systems, MYLEP PS for sports timing. Strategic tuck-ins, not huge bets.
Smart. What about returning cash to shareholders? Buybacks? Dividends?
They do both. They have an active share buyback program authorized another $300 million in February 2024. But the dividend is really a core part of their strategy. They've paid one for 22 years straight.
22 years. Consistent.
Very. And they've increased it for the last 8 consecutive years. For 2025, they're proposing a big 20% hike, up to $3.60 per share annually. And importantly, the payout ratio is only around 41%.
So lots of room to keep growing it.
Exactly. It's sustainable.
Now, connecting that back, you mentioned something earlier, ROIC, return on invested capital. How does that look for Garmin?
Ah, yes. This is where you really see the quality shine through numerically. Their ROIC trailing 12 months is a stunning 26.19%.
26%.
Yeah.
Yeah.
And you compare that to their cost of capital, their WACC, which is estimated around 6.8%. That spread over 19 percentage points.
It's huge.
It's massive. It's the hallmark of a truly high-quality business that earns way more on its investments than those investments cost. It means for every dollar they put to work, they generate over 26 cents in operating profit each year. That's the engine driving everything, the R&D, the dividends, the buybacks, while staying debt-free.
Okay, that ROIC number really puts their performance in perspective. Let's dig into the financials more formally now. Chapter 3, financial analysis. So let's hit the key metrics. What's their market cap sitting at right now?
As of our analysis date, around $44.07 billion. So solidly large cap.
And revenue growth. You mentioned a rebound. What does the 5-year trend look like?
It's strong. They went from about $4.2 billion in 2020 up to nearly $6.3 billion in 2024. That 2024 number was up over 20% year over year. Really strong growth, and it looked like it was continuing to 2025.
Okay. And profit margins, are they holding up with that growth? Gross operating net?
Yeah, remarkably stable and high. Gross margin is consistently around 58%, maybe 58.7% in 2024. Operating margin generally in the low to mid-20s was 25.3% in 2024. And net margin, also strong, around 22-23%.
Those are impressive margins, especially with so much hardware.
It really points to their pricing power and operational efficiency.
And free cash flow, the actual cash the business throws off.
Very healthy. It took a dip during those supply chain snags a couple of years back, but it bounced back strong. Over $1.18 billion in 2023, and then grew again to about $1.24 billion in 2024. That's the fuel for everything else we talked about, R&D, dividends, buybacks. Okay, let's look at financial stability. How consistent are their earnings over, say, 5-10 years? Really impressive track record. Their earnings per share basically more than tripled from $2.39 back in 2015 to $7.30 in 2024. Just steady compounding.
Wow. And debt.
That's one of their biggest strengths. The
Right.
balance sheet is like a fortress. They're effectively debt-free. The debt-to-equity ratio is negligible, maybe 2%.
Virtually no debt. Okay.
Yeah.
Liquidity. Current ratio.
Extremely strong. Current ratio is around 3, maybe even higher, depending on the source. Well over 1, meaning they can easily cover their short-term bills.
And the dividend again. Stable. Growing.
Yep, super stable. 22-year payment history, 8 straight years of increases. The proposed $3.60 for 2025 gives a yield around 1.6%, and that low 41% payout ratio means it's very safe and has room to grow further.
All right. The financials look rock solid, which brings us to the million-dollar question, or maybe the $44 billion question. Valuation analysis. Is it a good buy now?
Okay, let's look at the price-to-earnings ratio, the PE. Trailing 12 months, it's about 28.7.
How does that compare historically to peers?
Historically, it's near the high end of its 10-year range. The peak was around 31. So sentiment is pretty positive right now. Compared to the broader electrical products industry, which trades maybe around a 14 PE, Garmin's at a big premium.
Okay.
But compared to the overall tech sector, which is sky-high around 50 PE, Garmin looks much more reasonable. It suggests the market sees it as a top-tier industrial tech company, not necessarily a hyper-growth platform.
Right. Now, we also use a discounted cash flow model, a DCF, for intrinsic value. Can you just briefly explain that concept?
Sure, the DCF model tries to figure out what a company is really worth based on the cash it's expected to generate in the future. You project out those future free cash flows, then you discount them back to today's value, because a dollar tomorrow isn't worth as much as a dollar today, and you have to account for risk.
Got it. So, what did our educational DCF model suggest for Garmin?
Based on our inputs, the estimated intrinsic value range came out between $210 and $255 per share.
And what were the key assumptions driving that range?
We assumed free cash flow growth of about 8 to 10% for the next 3 years, kind of in line with recent trends and forecasts. We used a discount rate of 7% based on their estimated cost of capital, or their WACC. And then a pretty conservative long-term growth rate, the terminal rate, of 2.5%, just assuming it grows roughly with the global economy forever.
Okay, $210 to $255. We'll come back to that. Let's broaden the view now to part 2, external factors and outlook. All right, so we've seen the solid fundamentals, the valuation metrics. What's the vibe on Wall Street? What's the market perception of Garmin?
It's actually quite mixed, or maybe neutral overall, but with strong opinions on both sides. The official consensus rating from analysts is a hold.
The hold. Interesting.
Yeah, but that average hides the details. There's one strong buy, one hold, but also 2 sell ratings. So clear disagreement there.
And price targets.
The average 12-month target is $222. With the stock around $232 when we looked, that actually implies a small downside, about 4.5%. But again, the range is huge, from a low of $167 all the way up to $285. Shows you how differently analysts are modeling this.
That's a really wide range. What about news headlines? What's the general media tone?
It's also split. You see positive headlines on their performance, Garmin earnings beat, revenue topped estimates, product launches. But you also see more cautious analytical pieces questioning the valuation, like Garmin, a lovely but overvalued business. So positive on execution, cautious on price, digging into market indicators. Short interest is pretty low. Only about 1.5% to 1.7% of the float is shorted.
So not many big players betting against it?
Not really, although it had ticked up slightly. And technically, looking at price relative to moving averages, the stock's in a strong uptrend. It was trading well above both its 50-day and 200-day moving averages, maybe 8–11% above. That suggests positive momentum.
Okay, interesting mix of signals there.
Yeah.
Let's look at who actually owns the stock. Chapter 5, ownership structure. So who holds Garmin shares? Is it mostly big institutions, insiders, the public?
It's heavily weighted towards institutions, which is pretty typical for a company this size. They own somewhere around 57–58% of the stock.
Big names.
Yeah, the usual suspects. Vanguard, BlackRock, State Street, Artisan Partners are among the top holders. Insider holdings are also quite significant. Executives and directors own billions of dollars worth of stock collectively. Dr. Min Kao, the co-founder, hold about 9.5%. Director Jonathan Burrell has around 5%. That shows good skin in the game.
Any recent insider buying or selling?
There have been more sales than buys lately, but you have to look closer. A lot of them are tagged as automatic sells under preset trading plans or non-open market transactions. So not necessarily a negative signal about the company's prospects, could be diversification or estate planning.
Right, context matters. What about ownership concentration overall? Is anyone in control?
No single controlling shareholder. It's quite diffuse. The top 17 holders control just over half the company, about 51%, and the general public holds a pretty substantial chunk, around 37%. So shareholders do have a collective voice.
Okay, that paints the ownership picture. Now let's get into the potential downsides. Chapter 6, risk assessment. Let's use a SWOT analysis framework here. Strengths, weaknesses, opportunities, threats. What are Garmin's key internal strengths?
We've touched on many. That powerful brand recognition and loyalty. The product diversification across 5 distinct segments, their unique vertical integration, proven technological leadership, especially with things like Autoland, and of course that incredible financial strength, debt-free, strong cash flow.
And internal weaknesses, where are they vulnerable?
Despite vertical integration, they still have some supply chain dependencies, relying on single suppliers for certain components. Their heavy reliance on hardware makes them inherently cyclical, tied to consumer spending. They face market saturation in some developed regions, and their sales have seasonal fluctuations.
Okay. What about external opportunities? Where's the potential upside?
The growing wearables market, especially with AI and advanced health features, is huge. Expansion into emerging markets offers growth. Continued technological advancements, like more autonomous navigation or AI integration, and definitely growing those high-margin subscription services.
No. Now, for the threats, what keeps management awake at night? General external challenges first.
Intense competition, always. From the tech giants and specialized players, the need to keep up with rapid technological change requires constant heavy R&D. And cybersecurity risks are ever present for any company with connected devices.
And macroeconomic threats.
Yeah, they're definitely vulnerable to economic downturns. Their products are largely discretionary purchases. High inflation could also squeeze margins if they can't pass on rising costs.
Okay, but you mentioned a specific geopolitical risk earlier that sounded particularly acute. Can you elaborate on that?
Yes, this is a big one right now. It's the U.S.-imposed tariffs of 2025. These are significant. We're talking potentially 100% tariffs on chips made outside the U.S., and very steep tariffs, like 32% on consumer electronics like GPS units made in Taiwan.
And Garmin manufactures heavily in Taiwan and China.
Exactly. Their historical strength, that vertical integration in Asia, suddenly becomes a major strategic liability. It puts them in a really tough spot.
How so?
They either have to absorb those massive tariff costs, which would absolutely hammer their excellent profit margins, or they try to pass the costs on to customers, which could kill demand and hand market share to competitors who might manufacture elsewhere or have different supply chains.
Wow. So that turns a strength into a potential weakness almost overnight due to geopolitics.
It's a fundamental shift in their risk landscape, and it's happening now. Definitely the biggest external threat to watch closely.
That is a critical point. Okay, let's try to synthesize all this. Chapter 7, conclusion. So putting it all together, what's the elevator pitch for the bull case on Garmin? Why invest?
The bull case is strong. This is a high-quality, wide-moat company. It's got a powerful brand. It's diversified. It's a tech leader led by stable, proven management. The financials are pristine, debt-free, generates tons of cash, grows consistently, and boasts that incredible ROIC, proving its competitive edge.
And the bear case. Why be cautious?
The bears point to the high valuation. The PE is near its peak, leaving little margin for safety if things slow down. Competition is relentless, especially from cash-rich tech giants. The business is cyclical. And crucially, that huge geopolitical threat from tariffs targeting their core manufacturing base in Asia poses a serious, immediate risk to profitability.
And recapping our valuation summary, the DCF model suggested an intrinsic value between $210 and $255 per share.
Right. And with the stock trading around $232.38 at the time of analysis, it falls squarely within that fair value range.
So the conclusion is,
It looks like a wonderful company at a fair price. Not necessarily a bargain or a deep value play right now, but for investors focused on quality, who believe in management's ability to navigate these challenges, particularly the tariff situation, today's price could be seen as a reasonable entry point for owning a piece of a really superior world-class business for the long haul.
okay. So a final provocative thought for our listeners. Given these rising geopolitical risks, especially the tariffs, how does a company like Garmin, built on vertical integration in Asia, potentially innovate its supply chain to stay competitive? Or could this very strength become its Achilles heel in this new era of potentially fragmented global trade? Something definitely worth thinking about. All right, before we wrap up, please do us a favor. Like this video and subscribe to the Stock Analytics AI YouTube channel. It really helps us out.
Yeah, please do.
And remember, members get priority deep dives on S&P 500 stocks for just $4.99 a month. We're covering all 500 over the coming months, so members get that exclusive early access. Or if you just want this specific deep dive, drop us a super thanks.
And don't forget about the earnings coverage.
Oh, yeah. We'll be live covering Garmin's earnings minutes after they're released. Stay tuned right here on the channel for that.
And the important disclaimer. This analysis was generated by an AI system. It's for educational purposes only and should definitely not be taken as financial advice. Please always do your own research or consult with a qualified financial advisor before making any investment decisions.